Hello, and thank you for joining the latest edition of our Fixed Interest podcast series. My name's Ed Parker. I'm the head of sovereign research at Fitch Ratings. I'm joined today by Brian Coulton, Fitch's chief economist. In this episode, we'll be discussing the latest edition of Fitch's Global Economic Outlook. Brian, I guess quite a lot has happened since the April edition of the GEO, so why don't we kick off with your latest assumptions of tariffs and what that means for your new global growth forecasts?
Yeah, thanks, Ed. That's been really the main driver of the changes in this edition. We've lowered our assumption of the average US effective tariff very significantly since April. Back then, we were assuming something like 27%. We're assuming something like 17% now. So if we look at where we are right now in terms of what's the existing tariff rates that the US is applying, combine those with the product and geographical shares, we think the current rate is about 14%. Now that hasn't increased much since the previous estimate we published a few weeks back. Even though we've had this increase in steel, what we're finding is that the Canadian and Mexican exporters are moving more of their exports to a USMCA compliant basis. So that 14% in terms of current policy is a stable figure, but we're assuming in the GEO that it goes up a little bit. We've got the reciprocal tariff review expiring on July 9th. No one knows quite what's going to happen there, but of course some of those tariff rates could go back up again. We've got these Section 232 investigations into pharmaceuticals and semiconductors. That would be a big deal if he puts tariffs on those. And so we do think there is some scope for things increasing. We're kind of assuming a 15% tariff rate for the rest of the world. We're assuming some deterioration, but clearly much better than we were back in April. And that 17% assumption is quite close to the GEO assumption that we had in March. But what's interesting is that our growth forecasts haven't gone all the way back up to where they were in March. And the reason being that we just think the way US trade policy has been conducted in the last couple of months has been so dramatic, has been so aggressive, so volatile that it's just added a level of uncertainty out there to the world economy that we think is going to amplify the shock to the tariffs relative to what we thought was going to happen in March. So even though the tariff assumption is similar to March, the global growth forecasts haven't gone all the way back up. So we have raised our forecast for world GDP up to 2.2% this year from 1.9% in the April update, but that's still below where we were, where we were in March. But most countries have seen their forecasts increase. So the US back up to 1.5 now, China up to 4.2, and the Eurozone a little bit of a bigger revision up to 0.8. So across the board increases. So definitely better than where we were in April, but better doesn't mean good. This is still a pretty significant global slowdown. We're seeing a shock to world GDP of about 1 percentage point over this year and next year, and that's basically as a result of the trade war.
And are we seeing evidence of the impact of tariffs on the US economy starting to emerge? To what extent is it starting to show up in the surveys, the hard activity data or prices? And what inferences can you draw from the evidence at this stage?
Well, it's still early days, but there's clear evidence already, particularly in the trade data. So the most dramatic impact in the hard data as this massive surge in imports, in US imports in February and particularly March. And we saw a widening of the US trade deficit over $160 billion just in the month of March. Big part of that import surge was from Europe. So it's clear that US importers already moved. That surge in imports meant that the share of US domestic demand that was met by imports increased sharply, and mechanically that led to the decline in GDP. The largest negative contribution from net trade on record. And we've also seen evidence that inventories were a lot of those imports went into inventories. So I think on the hard activity data, that's the clearest sort of obvious sign of the tariffs increasing. The survey data has also deteriorated quite significantly. So there's a lot of different Fed surveys which are all showing business sentiment deteriorating. Consumer confidence indicators are weakened, although picked up in May relative to April on the Michigan measure, but still down quite a long way. Obviously, measures of uncertainty have gone through the roof, and a 10 standard deviation spike in the the policy uncertainty index. So a lot of survey data all pointing in the same direction. In terms of underlying trends in the hard data, what we are also starting to see now is increasing evidence of final domestic demand in the US. So stripping out net trade, stripping out inventories, that did slow down in the first quarter to 1.5% annualized, and we're seeing consumer numbers have been quite weak. Actually, we've had another negative print month on month in May. We had some very weak numbers beginning of the year as well. So, with 5 months of consumer data that's looking quite soft, government consumption is slowing down. And this is all happening before the negative drag on real wages that we see coming in the second half of the year as US inflation picks up. So I think it is all adding up to a picture of the tariff shock being a pretty significant impact on the US economy. We've not seen it in prices yet, to be fair. But I think that's partly just because of this false stalling, right? A lot of American firms bought in a lot of imports ahead of the tariff increases, and they're selling products out of that inventory at this stage. I also think the uncertainty itself probably discouraged a lot of firms from making big decisions on their final pricing. Just wait and see where things settle down. So I think it's still ahead of us. We still expect US inflation to pick up to nearly 4%.
And it's probably fair to say that US policies have also been having a significant impact on financial markets, given some of the moves in equity markets, US bond yields and the US dollar. How do you interpret those moves, and what might they suggest about potential risks that could lie ahead?
Well, it's been a bit of a surprise to see the dollar weaken as much as it has. I mean, if you look at the DXY index against other reserve currencies, it's down 10% this year. So, before the tariffs were implemented, a lot of people were touting this economic theory that higher tariffs mean a stronger dollar, and that clearly has not panned out. And I think when you put the dollar weakness into the mix with the volatility in the equity market that we saw after the April 2nd Liberation Day announcement, 12% down 12% in 4 days, and we've seen upward pressure on long-term bond yields, 30-year bond yields, and we saw a lot of intraday volatility as well in early April. It all kind of adds up to a picture of there being sort of increased investor concerns about the US outlook and about US financial assets. And the context here is you've got to remember the US is a large ongoing current account deficit economy that needs external financing because consumption exceeds production still. And that gap widened obviously in March with the trade deficit widening. And to encourage those capital inflows, it sort of feels like to us, that investors just require a better rate of return to continue to send that money into US financial assets. And remember, it's primarily portfolio investment that funds the US current account deficit. It's portfolio equity, portfolio debt. And so I think viewing it from that lens, perhaps it's not so surprising that when you have these policy announcements, which are going to be bad for US economic growth, are going to have implications for rates of return on certain parts of the equity market, which are going to be affected by the tariffs. Drawing a kind of emerging market type chart of the current account and the capital flows that fund it sort of helps you understand that pressure. I think this is a twin deficit economy that needs foreign funding, and when we have these policy announcements that worry investors, they're going to require a higher rate of return, and that means a cheaper dollar, cheaper bond prices, cheaper equity prices.
And turning to the rest of the world, you've revised up your growth forecast for both China and the Eurozone. Is China largely a tariff story, or are there other important dynamics at work? And there seems to be a growing confidence in Germany. Is it finally turning the corner?
So I think on China, it is mainly the tariff assumption. Just to reiterate, back in April, we were looking at an effective tariff rate on China for most of this year of over 100%. We had this headline 145% increase in the tariff rate. That translated, once you adjusted for all the carve-outs and everything, on our calculations to about 104%. We now think that number is just over 40%. So a huge change. And remember back in April, we were talking about the possibility of a complete collapse in US-China trade flows, right? Down 50, 60% plus. That was what we were talking about. I think that's been taken off the table, and so that's it's a much less aggressive US tariff shock towards China than we had before. That said, the economy is still struggling in terms of private domestic demand. Some of the recent property market indicators have kind of been heading south again. Housing starts, still falling at 20%. That's never really it suggested getting anywhere near hitting bottom. It did look as if sales have stabilised, but the last 2 or 3 numbers for sales have also been weak. So, the domestic private sector, we've got deflation pretty much entrenched. The consumer has been a little bit better recently, partly because of some of these fiscal incentive schemes. But it's really the key variable that's cushioning China's growth from the tariff shock, which is still pretty big, right? We're still talking a 40% tariff rate versus 10% last year. The key cushioning variable is on the fiscal side, and we are seeing increasing evidence of the fiscal support keeping the economy going. On Germany, turn the corner may be a little bit getting ahead of ourselves, but maybe bottoming out. I mean, we've got plus 0.1% growth this year versus a negative number, so that's better. But it's probably not going to be until next year that I think we're going to be seeing firmer signs of an upturn. But we are a bit more confident about that now because, despite the tariff shock, we're seeing increasing evidence that the consumer is starting to pick up slowly. Real wages have recovered from the inflation shock now, back to where they were before the gas price shock. We're seeing household lending pick up. We're starting to see the property market, residential side of things, residential construction, looking a little bit better. It does look as if some of the ECB easing is having a kind of desired effect on the economy. Saving ratios started to fall back again. So all those things are pointing to a consumer that's kind of like certainly looks to maybe finding its feet at last. And of course, we've got this huge change in fiscal policy, which we think is definitely going to help the economy recover. So on a 2-year view, definitely more optimistic about Germany, but don't hold your breath in terms of, great numbers in the next 6 months or so.
Then finally, what does this all mean for monetary policy? I guess it's the Fed that faces the trickiest decision on whether and when to cut rates given slowing growth and inflationary risks. And how do you see the political pressure on Jerome Powell? Will that have any impact on Fed decisions?
Yeah, I think you're right to highlight the Fed as being in a quite different position. I mean, we've said this all along, but it does feel very much like now that this tariff shock is net inflationary for the US, but net disinflationary for the rest of the world. And we are seeing rate cuts ongoing elsewhere. ECB sounding increasingly confident that the job is done on inflation, where the Fed have got this dilemma, and we're seeing this in some of the voting patterns as well. It looks like a little bit of a split emerging within the FOMC. Those that think rates shouldn't go down at all, and those think they should be cut quite quickly. But the issue is that everybody expects US inflation to pick up. We've had a big increase in household inflation expectations, and at this point growth is slowing, but not that dramatically, and not dramatically enough to really upset the labour market balance. So I think Jay Powell and the Fed are going to be pretty patient in terms of holding rates where they are. We think until October. I don't think he's going to buckle under the pressure from President Trump as long as he's in that job. And he very much dominates the committee. So even if you have a shadow new Fed governor, I don't think that's going to make much difference. He's still going to be driving the bus, and I don't see him willing to cut rates until the fourth quarter.
Great. Thanks, Brian, for your insights, and thank you all for listening. For more on Fitch's economic forecasts and analysis, please visit Fitch's website, fitchratings.com. We hope you join us for the next edition of Fixed Interests.